Hey everybody, Marty Missouri here, September 1st, 2023 with your weekly economic update, and we'll do a quick stock market snapshot at the end. In front of you is our PWA index. It stayed at a negative 19 on the week, although we did get a little bit of movement. We had two of our inputs deteriorate and we had two improve. The end result was, again, the overall score, negative 19.15, remained the same. However, the percentage of inputs that score positive dropped 2% to 19. The percent that score negative, however, also dropped 2% to 38. The 4 points went to the neutral columns. I decided to show you retail sales because we capture the Red Book weekly numbers, and that actually has increased now for the fourth week in a row, I believe. No, actually the fifth week in a row. As you can see, it's shot up above what was a clear down trend line here. So that would be unambiguously positive about the state of the consumer and the state of the economy if we're seeing a nice ramp up in consumer spending. Now, I did go back earlier when I scored that and I zeroed in at a year at a time, and there does seem to be some seasonality right around now. So the personal consumption expenditure data came out, and we'll look at PCE inflation here in a second as well. So this would be the consumer spending element there, and it was up surprisingly 0.8% on a month-on-month basis. Personal income disappointed. 0.3% was what was expected. 0.2% is what we got. Personal income still up 4.6% on a year-on-year basis. Consumer confidence, we talked about the University of Michigan's last time. The Conference Board's consumer confidence number came out, and that went from positive to neutral. Both of them went down. And again, we're not scoring historically high in either case. We just had a pretty nice trend here of late. It was at 114. It dropped to 106.1. One-year inflation expectations rose 0.1% to 5.8% after declining in July, so that's not good news with regard to the Fed's intent. There was weakness in the labor market oriented questions. Folks who said that jobs were plentiful fell 3.4 points to the lowest since April of 2021. And those that said that jobs are hard to get rose by 2.8%, the most also since April of 2021. Spending intentions were pretty flat relative to the previous month for major purchases like autos, homes, and appliances. A report said that write-in responses showed that consumers were once again preoccupied with rising prices in general, groceries and gasoline in particular. So here we have evidence, and some of that we'll talk about here in a second in the jobs data. Certainly with the negative score of our index, we have evidence that the economy is slowing. However, we still have people really struggling with higher inflation, which is quite the conundrum if you're on the Federal Reserve Board. So the all-important August jobs number came out this morning, and I had Bloomberg TV playing in the background, and man, you would have thought this was about as good as it gets. You know, Goldilocks was mentioned several times, right? Not too hot, not too cold. All the guests came on and said the Fed's going to have to love this. Stocks rallied pretty nicely, up like 0.2% across most of the averages right off the bat. But not long after, the data began to get digested, stocks kind of came off the boil a bit. Yeah, the headline number was better than expected at 187 versus 170,000 jobs. Unemployment jumped from 3.5 to 3.8%, and that was higher than expected. The participation rate rose by over 700,000. That probably has a not small something to do with the unemployment rate rising, because those people are now in the workforce, but they're not yet working. Although you've got the screenwriters are on strike, and yellow trucking, right? They went out of business to the tune of 37,000 people, and of course, losing their jobs. So if you add those back in, you might have had a number that was pretty scary to Wall Street. So we've got to put all those kind of caveats in place as we think about this. Wage growth slowed to 0.2% month on month, but still 4.3% on a year-on-year basis. We already talked earlier this week about the quits rate dropping, about JOLTS dropping. Big jump in labor force participation rate was interesting, though. That was more than what was expected. And again, it was over 700,000 people came back into the workforce. There's an argument, I think, to be made, at least to be considered, that could speak to the fact that these excess savings or the pandemic savings, call it the free money folks were given, has been getting spent down, and it looks like that spend down is getting accelerated now. The ISM manufacturing number that came out this morning, we'll get the services next week, that actually is coming up. Now, keep in mind, a 47.6 means that relative to last month, the manufacturing sector is still contracting. Okay, anything below 50 means it's going in the wrong direction. And this is like the 10th month in a row. So manufacturing's in recession in the US. The fact that it's 47.6, and you can see it's gone up the last couple of months, means that it's just decelerating at a slower pace. Now, I listened to an interview with the chief economist for ISM this morning, and it was interesting to listen to him because he was pretty optimistic. He said, this looks like we're now finally bottoming in manufacturing. You can see that, of course, these things start going up when they bottom. Bottoming to me means that you've moved back above the deceleration line, meaning can you say we've bottomed when we're still decelerating? I know how this chart looks, but keep in mind that's still weakness. It's just a little less rapid, or somewhat less rapid weakness than the month before. And I'm not saying that's not how it starts, but it's just interesting to put it that way. In terms of some of the detail, new orders did slip again. So they take all these components and they use that 50 dividing line between expansion and contraction. So new orders slipped to 46.8. They were 47.3. That's obviously not a positive. Prices paid rebounded to 48.4 from 42.6. Now, that sounds like a lot. Uh-oh, that's inflation. No, it's not inflation. It's just prices coming off the boil at a slower pace than the month before, but still coming off the boil. Export orders, which speak to the global economy, are still in that contraction mode at 46.5. And 5 of the 18 industries, that's it, saw growth. But that's up from just 2 in July. So better than it was in terms of less bad, but not anything that you'd get too excited about yet. It's going to be really interesting to see how the services sector purchasing managers feel about their lots going forward. The PCE deflator, so the inflation data that came out today with personal consumption expenditures, headline number, which includes food and energy, was up 3.3%, 0.2% on a month-on-month basis. Core PCE inflation, which excludes food and energy, actually was up 4.23%. So that's too hot relative to the Fed's mandate. Better on a month-on-month basis than what was expected. We have base effects that'll affect the year-on-year print, but make no mistake, folks, there's quite the gap between here and where the Fed says they have to be before they start easing up on monetary policy. The Bloomberg Commodity Index looking a little better. We've had several weeks here of, chopping around. Right now, there's enough there to take me from negative to neutral in terms of, what rising commodity prices say about the state of the economy. Of course, too much of a good thing leads to more inflation, and that's an issue for the Fed, but that's where we are currently. So folks, that's probably enough for this week in terms of the economic data that's come out. Let's just take a quick look at the market. So recall that we had what was sure looking like a bear flag pattern. We had broken down below it, tested here and failed. So I was suggesting that there's pretty good odds that we would continue down and get in here and probably ultimately test this uptrend line off of the last October low. So now we are testing the trend line off of the March low, right? And you can see right here we're bouncing along that 1, 2, 3 last 3 days in a row. holding above the 4,500 spot on the S&P and above the 50 and the 20-day moving averages. So this will be interesting to see. A failure here could be quite negative. A few more up days and we're going to have a marginal new high, but no way will we be at that point getting the confirmation we would need from these momentum indicators. Might come close on the RSI. So yeah, again, it looks like a very heavy market to me. You wouldn't think there's a tremendous amount of upside here. Recall the last update I did in the middle of the week where I showed you where we are in terms of valuations compared to historical norms. And then lastly, quick look at QQQ, the ETF that tracks the NASDAQ 100 index. So we had that, makings of a bear flag pattern that failed, and we ramped up here with some real momentum, tested that downtrend line off the January low, and just ramped above the 50 and the 20-day moving averages. Pretty strong stuff. Fell off today, right at that 380 resistance that I had drawn here. And when we look at momentum, we do have our buy signal here on the MACD, but there's virtually no way that we're going to confirm a rally here unless it's just massive momentum for several days in a row. So again, it's kind of plodding its way higher, but you're not getting the underlying support from the technical indicators that we tend to respect the most. Our concerns remain in terms of potential downside risk in a very cloudy, let's say, macro picture, to put it mildly. So stay tuned. I hope you have a great long weekend. Thank you as always for watching and listening, and I'll talk to you again next week. Take care. Bye-bye.